Hello friends, welcome to my another video on accounting. This video is about accounting concepts and conventions. So let's get started. Firstly, we must know that what are the accounting concepts and conventions. See, we all know that accounting statements or the financial statements are prepared to know the profitability and the solvency position of the organization. But these financial statements prepared by the accountants should be reliable and should be comparable. By comparable, we can say that the financial statements of one firm should be comparable with the financial statements of another firm, and also the financial statement of one particular year should be comparable with the financial statements of another year of a single firm. Right? So in order to make these financial statements reliable and comparable, it is very essential that all the firms, all the accountants prepare their financial statements based on certain rules and regulations. So for the adoption of the certain rules and regulations that have been made by the government, that have been made by the law, we can say that accounting concepts and conventions have been set for the accountants. So it is must for the accountants to prepare their financial statements, to prepare the accounting statements of the firm according to these concepts and conventions, so that it is possible to compare, so that it is possible to rely upon those statements. Okay, so we can say that accounting concepts guide the accountants that how the transactions should be recorded in order to make the accounting language convey same meaning to all. Right? So all the persons involved, all the persons interested in the financial statements, they can withdraw same meaning from these financial statements. So they can withdraw same meaning from these financial statements. For that purpose, these accounting concepts and conventions have been made. Right? So firstly, we will be discussing the accounting concepts, and then we will be shifting towards the accounting conventions. The very first accounting concept is the business entity concept. What does this concept says? This concept says that the business and the proprietor are both separate entities, are both separate persons. They are not interrelated with each other. They are totally different from each other. That is why the transactions in the books of the account are entered from the point of view of the firm and not from the point of view of the proprietor. So don't mix the business and the owner, don't mix the owner of the firm and the business entity. They are completely different, and all the transactions which are made in the books of the accounts are made from the point of view of the business and not from the point of view of the proprietor. Right? So don't mix the personal and the business things. All the transactions will be solely based on the firm's viewpoint and not from the point of view of the owner, not from the point of view of the proprietor. This is what business entity concept says. Right? So if we follow this particular concept, so according to this concept, if I am saying that the proprietor is separate and business is separate, so proprietor or the owner will be creditor for the firm, because the proprietor has given money, the proprietor has given or invested capital in the business. Right? So that proprietor will be creditor for the business because the business owes the amount to the proprietor which he or she has invested in the business. Right? So according to the business entity concept, proprietor or owner will be creditor for the business because the firm owns the amount invested by the proprietor in the business. The business is supposed to pay back that invested amount to the proprietor back in the near future. So the amount invested by the proprietor, that is capital, will be the liability, because the company has to pay the amount invested by the proprietor, that is capital. So for the company, that amount of capital will be liability and the proprietor will be creditor. Right? Similarly, the amount of capital which has been invested by the owner, some amount of interest also is supposed to be paid by the business and some interest is also supposed to be paid by the business on that capital, right? So that interest which will have to be paid by the business to the owner will be the expenditure for the firm. It will be an expense for the business, right? That rate of interest can be 5% or 6% on the amount of capital invested. So that amount of capital will be the liability, but the amount of interest that the firm is supposed to pay on that capital will be a complete expenditure for the business. Similarly, sometimes the amount of money or the amount of goods which are withdrawn by the owner for his or her personal use, which are known as drawings, right? So that is why we take those amount withdrawn or the goods withdrawn by the owner for his personal use as drawings, because the proprietor is different and the business is different, right? Proprietor is using the goods or money for his personal use and not for the use of the business. So if the goods and money are being used for the personal purpose of the proprietor, then those will be the drawings, right? So from this business entity concept, we can completely relate to that the transactions are completely made on the point of view of the firm and not from the point of view of the proprietor. The proprietor and the firm are two separate things. Proprietor has invested the amount of capital in the money, so proprietor is creditor, and the amount of capital which has been invested by the owner will be liability for the firm, because the business has to pay back that amount of capital back to the proprietor, right? Interest on capital will be the expenditure for the business, and the amount of money or amount of goods which have been withdrawn by the owner for his personal use are the drawings, right? So it is because of this business entity concept all these things are considered into mind while preparing the books of the accounts, right? Okay, I hope this concept is clear. Let's move forward with the next accounting concept, which is the money measurement concept. See, it is the very first process of it is the very first step in the process of the accounting that all the monetary transactions are identified by the accountant, right? So only those transactions which are monetary in nature, which can be measured in the terms of the money, will find their space in the books of the accounts. Any other transaction which cannot be measured in the terms of the money will not be recorded in the financial statements, right? So even though an event is very important for the business, will not be recorded in the books of the accounts unless and until its effect can be measured in the terms of money, right? There can be any kind of strike going on in the organization, there can be any quarrel between the manager and the employees of the firm, but although these two things are very important for the firm, but because the effect of these two things cannot be measured in the terms of money, these will not be recorded in the books of the accounts, right? So only those transactions, only those events which can be measured in the terms of the money will be finding up their place in the books of the accounts, in the financial statements, right? So if we say that the firm is having rupees 50,000 cash with itself, okay, go ahead, this transaction will be recorded up in the books of the accounts. But if it is said that there is a 10,000 kilogram of raw material lying up with the organization, no, this information is of no use while making up the books of the accounts. The information that will be useful is the worth of the raw material when the value can be measured in the terms of money. So if we say that the raw material cost rupees 1 lakh is lying up with the organization at the end of the accounting period, then that information will be entered in the books of the accounts. If we say that 20,000 kilogram of finished goods are lying up at the end of the year, no, this information will not be recorded up in the books of the accounts. But if we say that the finished goods worth rupees 2 lakh are standing there in the godown, then yes, that will be entered up into the books of the accounts. If I say that 10 machines, if a firm is having two buildings, right, then this information is of no use for the accountants. But similarly, if I say that the machine's value is rupees 5 lakh and the value of the building is rupees 20 lakh, then yes, this information is of the use for the accountants because it can be measured in the terms of the money and it will be entered into the books of the accounts, right? If we say that a very crucial person, maybe MD, is resigning from, or any crucial manager is resigning from the firm, then this seems to be very crucial event for the organization. But because this event cannot be recorded up in the terms of the money, it will not be there in the books of the account. But yes, the effect of this transaction, when comes up into the effect that rupees 3 lakh had to be paid as the form of the monetary compensation to the managerial person who is resigning, maybe in the form of gratuity or in the form of the leave encashment, then this event will be there in the books of the accounts because it is completely in the terms of the money, right? So key managerial resigning of the organization is of no use till the time its effect can be measured in the terms of the money. And then if its effect is rupees 3 lakh, then yes, this thing will find up this in the books of the account, and the accountant will be entering this amount in the books of the accounts, right? So the money measurement concept says that even though any transaction is very important, but till the time its effect cannot be converted in the terms of the money, it will not be there in the books of the accounts. Okay, so this was the money measurement concept. Now moving ahead with the next concept, which is the going concern concept. What does this concept says? This concept says that while making the books of the accounts, the accountants assumes that the organization or the business will be there in the existence for a longer duration, right? It will be going on, it will be running up for a fair amount of time in the near future, right? It cannot be said that the company will be winded up next year, considering this the accounts will be prepared. No, the accounts will be prepared by the accountants, keeping into consideration that the firm will be there in running, the firm will be running up in the future for a long term. So a firm will be a going concern in the near future. Keeping this in mind, the accounts are prepared by the accountants, right? And it is because of only this concept, the full cost of the machinery is not treated as an expense in the year of its purchase, but it is spread over the life for calculating the net profit or loss. So while preparing the books of the accounts, suppose that a machinery worth rupees 10 lakh has been purchased by the organization, right? So this total amount of rupees 10 lakh will not be written up in the financial statements of the financial year 2022. If in the financial year 2022 a machinery worth rupees 10 lakh has been purchased by the business, then this total amount will not be treated as an expenditure of the year 2022, because it is assumed that the firm will be there in existence for a longer period, firm will be running up in the near future. So this total amount will be spreaded up for the life of the machinery. So if I say that this machinery is going to help in the production of the goods for next 10 years, so in the financial statements of these next 10 years, this amount will be distributed. It is only because of this concept that the total amount of machinery, the total cost of machinery will not be recorded up in the financial statements of 2022. Rather, the total cost of the machinery will be spread over its life, that is 10 years. So for the financial statements coming up in the next 10 years, this amount of rupees 1 lakh for the next 10 years will be shown in the each financial statement, right? And it is on the basis of only this concept that the long term contracts are entered into. So if we assume that yes, the company will be there in the future, then only the company will be entering up into the long contracts with the suppliers, right? It is only on the basis of this concept that yes, the company will be there in the future, only then the loans will be providing up the banks will be providing up the loans to the bank, or the overdrafts from the bank can be taken up, right? If the firm is going to wind up in the near future, then no bank will be providing the loan or the overdraft to the organization, right? Because the firm is going to stay in the near future, only because of this thing the banks are going to provide the loan and the overdraft facility to the organization, right? We all are aware about the concept of outstanding and the prepaid expenses, right? Outstanding expenses are those which are supposed to be paid by the organization in the near future, right? So only because the organization is going to stay there for the future, then only the concept of the outstanding expenses is there, right? We say that the firm will pay the amount of outstanding wages worth rupees suppose 10,000 in the next financial year. So if it is known that the firm is going to stay for a longer period, then only this amount of outstanding wages will be entered up into the books of the accounts. Similarly, if an organization has prepaid certain expenses, for example, the insurance premium worth rupees 10,000 has been paid by the firm in advance, right? So if the prepaid expenses are there, this means that the firm is going to run in the next year, then that amount of prepaid expenses will be adjusted in the financial statements of the next year, right? So the going concern concept says that the firm will be there in the existence for the coming number of years, right? And it is on the basis of this concept only the market value of fixed assets is irrelevant. Fixed assets are always recorded up at the cost at which they were purchased and not the market value, right? The market value, suppose the asset or the machinery which was purchased was worth rupees 10 lakh, right? But the market value later on after 6 months or after 2 months turned out to be 12 lakhs or 13 lakhs, right? So that market value of the fixed asset will not be recorded up in the books of the accounts. Only the cost of the machinery, that is rupees 10 lakh, will be recorded up in the books of the accounts, right? So these concepts, whether it is business entity, money measurement, or going concern concepts, these all are guiding the accountants how to make the entries of the transactions in the books of the accounts, right? So these concepts are all basically the guidelines for the accountant to know how to make the entries in the books of the accounts. Okay, coming up with the accounting period concept, right? See, it is very essential for the users. It is very essential for all those persons who have invested their interest in the business to know what is the running position of the business, whether it is in the profits, whether it is in losses, and what is the solvency position of the organization, right? So evaluation of the performance of a business is very important. Evaluation of the performance of the business has to be done at the regular intervals so that the necessary steps can be taken, right? It is not possible that we are performing the evaluation of the business after 10 years or after 12 years. Then after if there has been certain setback, then how we will be able to control that, because 10 years or 12 years would have elapsed, right? So it is very essential that the evaluation of the performance of the business is done at regular intervals. Regularly we should analyze the performance of the business so that the management can take the necessary decisions, right? So in India, that time period has been decided up to 12 months. So after 12 months, the financial performance of all the business organizations are analyzed, and the financial year has been set up to 1st April to 31st March. So financial years always starts up with 1st April and they end up on 31st March. So on 31st March, all the financial statements are issued by all the types of the business organizations. On the last day, all the books are presented up by the firms in the form of trading and profit and loss account and balance sheet, right? So on 31st March, the end of the accounting year, or you can say the financial year, the books of the accounts are required to be prepared by all the firms. Every type of the firm, they will be preparing their financial statement for the complete year, and on 31st March these will be presented in the form of trading and profit and loss account and balance sheet, so that the performance of the evaluation of the business performance can be made by the management, and the important decisions can be taken up by all the users of the financial statement. So in order to make a good evaluation of the performance of the businesses, the complete performance of the business for a particular financial year, for a particular period of 12 months, has to be done by the business organization. Or even you can say that sometimes you can also see the financial statements of quarterly, or some firms are even making up their financial statements after 6 months, right? So this 12 months, it is very compulsory for each and every organization to prepare their financial statement, trading and profit and loss account after 12 months. But the firms, they can also prepare their financial statements after 3 months or after 6 months as they find suitable. Right? I hope these 4 concepts are clear. Let's move forward with the next concept, which is the historical cost concept. Right? So what does this concept says? This concept says that the assets will be recorded up in the books of the accounts at the cost at which they were acquired and not at the market value. Right? So for example, if I say that a land and building was purchased by the business worth rupees 50 lakhs, right? So this amount of 50 lakhs will be recorded up in the books of the accounts irrespective of the value, whether the market value has raised to 60 lakhs or it has declined to raised to 60 lakhs or 70 lakhs, right? So it is of no importance. The market value is of no importance. Market value will not be taken up into the books of the accounts. Only the historical cost, or the cost we can say at which the assets was acquired, will be entered up into the books of the accounts, right? So the assets are shown in the books of the account at the cost at which it was acquired, and obviously because all the assets have to depreciate from time to time, so that amount of depreciation is deducted from the value or the cost of that particular asset for the years to come. So assets will be shown in the books of the accounts at the cost minus depreciation, right? So suppose if we are making the balance sheet of the organization, so if an assets it was worth rupees 50 lakh, right? So suppose its rate is declining up, and the depreciation is amount of 10%, so 5 lakh will be reduced and the amount of 45 lakh will be shown in the books of the accounts, right? So market value will not be taken into consideration. Suppose the market value is 60 lakh, right? So the 60 lakh will not be recorded up here. Only the cost of the asset, the cost at which this asset was acquired minus the amount of depreciation will be recorded up in the balance sheet for any year ended. Suppose for the financial year ending 2022, so the balance sheet for the year ended 2022, the asset will be shown at the price of 45 lakhs, right? Okay, coming up next is the dual aspect concept, and it is a very crucial concept in accounting because all the accounting transactions are recorded on the basis of the dual aspect concept, which is also said that based on the system of double entry system, right? See, every transaction which is recorded up in the books of the account, it will affect at least 2 accounts. I'm saying not 2 accounts, it will affect at least 2 accounts, right? So any transaction, any kind of transaction is taking place, then it will be affecting at least 2 number of accounts. It can be 2 or 3 or 4, but at least 2 number of accounts will be affected. And another thing, if one account is being debited, then the another will be surely credited. Right? Every transaction will be affecting at least 2 accounts. If it will be, if one account is being debited, then another account will be there surely which must be getting credited, right? So if one account is getting debited and another account is getting credited, so obviously there will be a balance, there will be a equality, right? And it is only on because of this concept that you will find the 2 sides of balance sheet always equal, right? Balance sheet that we prepare has 2 sides, right? One side of the balance sheet is the capital and liabilities, and another side of the balance sheet is all the assets, right? So on the right hand side the assets are recorded up, and on the left hand side of the balance sheet you will find capital followed by the liabilities. And always at any point of time the total of these 2 sides will always be equal. Capital plus liabilities will always be equal to the assets of the organization at any point of time, right? And why this is so? Because every transaction, if it is taking place and if it will be affecting one account which will be debited and another account which will be credited, right? So if debit is going there, credit is going there, it is making things equal, right? So capital plus liabilities will always be equal to the asset side, right? The two sides of balance sheets will always be equal, and this is also known as the accounting equation. What? Assets is equal to the capital plus liabilities, right? Because we know that the capital is assets minus liabilities. If we deduct the amount that the firm owes from the amount from all the things which are in the possession of the business, then what is left is capital, right? So we can also say that the assets are equal to capital plus liabilities, right? This is what are the two sides of the balance sheet: assets on the right hand side and the capital plus liabilities on the left hand side, right? So the two sides of balance sheet will always be equal. It is only because of this dual aspect concept that the balance sheet will be having an equal position at any point of time, or you can say that the accounting equation, which is assets is equal to capital plus liabilities, will always be holding good after each and every transaction. If one transaction has taken place, then also this particular equation will always be there equal. This balance will be standing equal. If n number of transaction has taken place, then also you will be finding this equation to be equal, right? Let's take an example, right? Suppose that an asset worth rupees 50 lakhs, right? So 50 lakhs was purchased from suppose, and for purchasing that particular amount of asset 50 lakhs, the owner had invested up the amount of money of 10 lakhs. So this capital would be 10 lakh, and the 40 lakh loan was taken up for purchasing this particular amount of asset. So the land and building machinery asset, on the place of the asset I have written 50 lakhs, and for purchasing that 50 lakhs, 10 lakh was taken up by the owner in the form of cash, that is capital, and 40 lakh loan was taken up, right? So you can see that the accounting equation is holding equal. The total of the assets, left hand side, this assets is equal to the capital plus liabilities, right? So you will always be finding whenever any transaction is taking up, it will be making the accounting equation equal. So suppose I said that I purchased the goods worth rupees 25,000 in cash, right? So if I purchased the goods worth rupees 25,000 in cash, so it increased the asset side 25,000 because I bought the goods, so the value of my assets has increased. But because I purchased those assets in the form of cash, it also deducted up my amount of cash, right? On one hand, the stock was increased, but on the another hand, the cash was reduced, right? So ultimately, this total was nil, and 50 lakh will be equal to this side of liabilities plus capital. So see, this transaction, it affected two accounts, right? If one was of the stock and another was of cash, right? All right, so the next accounting concept is the revenue recognition concept. Now, what does this concept says? This says that the financial statements should incorporate the income that has been earned during the year, irrespective of the fact that it has been received in cash or not. Say, for example, if the organization has sold certain goods amounting rupees 1 lakh, right? And these has been sold during the financial year 2022. So this amount of the sold goods of rupees 1 lakh will be entered in the books of the accounts, irrespective of the fact that 1 lakh has been received in the cash or not during this year, right? So if the payment will be received in the next year, then this thing does not matter. If the amount of rupees 1 lakh belongs to this financial year 2022, then this sold amount of sold goods of 1 lakh will be recorded in the financial statements of the year 2022, right? So it does not matter whether the cash has been received or not. If the income has been earned during a particular financial year, then that will be incorporated in the financial statements in the final accounts, right? Let's take an example. For example, if the rent for the month of March 2021, it was received in April 2021, But this revenue, this rent, because it belonged to the financial year 2021, it will be recorded up in the balance sheet. It will be recorded up in the financial statements for the year ended 31st March 2021, right? These will not be recorded in the financial statements of the next financial year beginning of April 2021. No, that will be recorded up in the financial statements for the year ended 31st March 2021. Right? So when you will be preparing the profit and loss account for the year ended March 31, 2021, so on the right hand side, obviously because it is an income, so it will be recorded on the right hand side of the profit and loss account. All the incomes are recorded up on the right hand side, and all the expenses are recorded on the debit side of the profit and loss account, right? So when we will be writing up this amount of 55,000 on the income side of the profit and loss account for the year ended 31st March 2021. So say for example the rent was 55,000 and 5,000 was will be received in the month of March, in the month of April 2021, right? So, but this amount of 5,000, because it belonged to this financial year, so it will be entered here in the books of the account of this financial year, whether it will be received in April or not. But because this belonged to the financial year March 31, 2021, it will be recorded up here in the books of the accounts, right? So we will be writing up by rent 55,000 plus accrual rent. By accrual rent, we mean the amount of rent which is supposed to be received in the near future, which will be received in the month of the April, right? But it will be recorded up here because this belongs to this particular financial year. So a total of 60,000 will be recorded up in the March 31, 2021 profit and loss account, right? Similarly, suppose that the rent for the April 2021, month of the April 2021, it has been received in advance in the month of March 2021. However, it belonged to the next financial year, but it was received in the advance in the month of March 2021 in this financial year. But this belonged to the next financial year, right? The next financial year will be beginning from the April 2021. So because it belonged to the financial year April 2021 beginning, so that amount of rent will be recorded up in that particular financial year and not in this year, right? So let's take an example. There was an amount of rent, that is by rent we will be writing up 65,000, right? But because this amount of 5,000, it has been received in advance, right? But this does not belong to this particular financial year. It will belong to the financial year that will be starting up from April 2021. So this will not find in the financial statements of the financial year ending March 31, 2021. Right? So because it does not belong to this financial year, it will be deducted up, it will be subtracted from the amount of the rent. So total rent was 65,000 and 5,000. This does not belong to this year's financial year. It belongs to the next year's financial year, right? So because it does not belong to this financial year, it will be deducted up from the total amount of the rent, and only 60,000 will be recorded in the credit side of the profit and loss account. Right, here we are deducting this 5,000 amount because this does not belong to this particular financial year. It was received in advance. This is unearned income, right? It has not been earned in this financial year. It will be it was of the next financial year, but it was received in advance in this year. So because this does not belong to this financial year, it will be written up as unearned income. It was not earned in this year, and this amount of unearned income of 5,000 will be deducted up from the total amount of the rent, right? And here up, because an amount of 5,000, it was not, although received in this financial year of March 31, 2021, but it belonged to this year, right? It belonged to this year, whether the amount will be received in the next financial year. But because this amount of 5,000, it was not received in cash, but it belonged to this particular financial year, it will be recorded in the financial statements of the March 31, 2021, and the total amount of 60,000 will be written up on the total amount side. Right? So here it was accrual rent, the rent which was not received in cash, but it belonged to this year. And here the 5,000 was the amount of the earned income, did not belong to this particular financial year, because it was earned in the next year. However, it was received in advance in this year, right? So the accrual rent and the unearned rent, this both were made adjustments while making the financial statements, right? So the revenue recognition concept says that if an income has been earned in a particular financial year, whether the amount of cash has been received or not, revenue has been made, right? Income has been made during the particular financial year. It does not matter that the cash was deposited in your bank account or not, the cash was received or not, right? So if it was earned in the particular financial year, irrespective of the fact it was received in cash or not, it will be finding up, that income will be finding up the place in the financial statements, in the final accounts of that financial year only, right? And we learned this from these two examples. Okay, now coming up with the next concept of accounting concept, that is the matching concept, right? I hope that till now all the concepts are clear. The next concept is the matching concept. Matching concept says that while preparing the financial statements, while arriving at the profit for a particular financial year, all the expenses which were relevant for that current year's for the year's sale should be shown, right? So when we will be preparing the profit and loss account, on the credit hand side we will be showing the amount of sale, we will be showing all the incomes related to that, related to the organization. So if we are showing on the credit side the amount of the sale, then on debit side all the expenses which have been made in generating that sale should be recorded on the debit side, so that the correct amount of the profit can be known, right? So when we will be preparing profit and loss account for the year, for any financial year ending, so we will be writing up here by sales, right? So a sales amount would have been generated. In generating this sale, all the expenses, number of expenses would have been made. So all those expenses need to be written up on the debit hand side in order to know the correct position of the profit, right? So from this amount of the sale, all the connected expenses will be deducted, right, from the amount of sale. Suppose that the amount of the sale was rupees 10 lakh, right? So in generating this sales, number of expenditures would have been made on raw material, on payment of wages, right, on payment of salaries and so on. So all the expenses need to be deducted from the amount of the sale in order to know the correct position of the profit of the organization, right? So this is what the matching concept says. All the relevant expenses which have been made for the current year's sale should be shown, irrespective of the fact that whether the cash has been paid or not. In the last concept, in the revenue recognition concept, we said that the revenue has been earned, right? So if a revenue has been earned, it should be recorded in the books of the accounts whether the cash has been received or not, right? So the matching concept says that all the expenses related to the current year should be shown, irrespective of the fact that the cash has been paid or not, right? So all the expenses related to a particular financial year will be shown in the profit and loss account, irrespective of the fact that the cash has been deducted from your cash balance or your bank balance, right? So the payment in the terms of the cash does not matter. If an expense relates to a particular financial year, then that expense will be finding up the place in that particular financial year's statement, right? Let's take an example. The organization, we all know that it pays salaries, right? So suppose that the salary was not paid for the month of the March 2021. So we are preparing the profit and loss account for the year ended 31st March 2021. So till the month of March 31, till this March 2021 month, all the expenses, whether paid in cash or not, will be recorded on the debit hand side, right? So there was a salary, total salary was like 11,000 was paid by the organization, but an amount of rupees 1,000 was not paid by the organization in the month of March 2021. But because this amount of 1000, although paid in cash or not, it belonged to this year. It belonged to the financial year ending March 31 March 2021, right? Because it belonged to this financial year, it will be recorded on the debit hand side of the profit and loss account for the year ended 31st March 2021. Right? So for the financial year 2021, this item was belonging to this particular financial year, so it will be recorded here, right? And how it will be recorded? It will be recorded by the name of outstanding salary. Outstanding salary means this salary is due. The company has not paid this salary in the form of cash of 1000, but this belonged to this particular financial year, so it will be recorded up, and the total amount of 12,000 will be recorded on the payment or debit side payment column, right? So to salary, in the profit and loss account debit side, we will be writing to salary. Suppose 11,000 salary was there, 1,000 has not been paid, so this 1,000, although it has not been paid in terms of cash, but because this payment of 1,000, it belonged to the financial year, this financial year, it will be added up in the amount of 11,000, and a total of 12,000 will be shown on the shown in the payment column. Right? Similarly, let's take another example. Suppose that there was an insurance premium, but it was paid in advance for the month of April 2021. For the next month, we are preparing the financial statements for the year ended March 2021, right? So there was an amount of rupees 5,000 which belonged to the month of April 2021, but this was paid in March 2021, right? So how we will be recording this? We will be writing on the debit hand side to insurance premium. Suppose the amount was 35,000, and this amount of the prepaid insurance premium, prepaid means that it has been paid in advance. So because this payment of 5,000, it did not belong to March 2021, it did not belong to the financial year ending March 2021, it will not be finding the place in this year's financial statement, because this payment was of April 2021. So when the financial statements for the next year will be prepared, this amount will be shown there and not here. So that is why the amount of 5,000 has been deducted by the name of prepaid insurance premium 3031. We deducted this amount of 5,000 because it did not belong to the financial statement. It did not belong to the financial year ending March 2021. It was paid in advance, right, for the next year. So the payment has been made in advance for the next year, so it belonged to the next year. This does not belong to this year, so this amount was deducted, right? So the payment, see, of the outstanding salary of 1,000, as we discussed earlier, because this belonged to the March 31 2021 financial statements, it was added up here, whether it was paid in cash or not, right? And here an amount of rupees 5,000 of insurance premium which was paid in advance for the next year. So because it belonged to the next year, it was deducted from here, right? And an amount of 35,000 minus 5,000, 30,000 will be shown in the payment column, right, in the amount column. Right? So I hope this matching concept is clear, right? Matching concept is saying that all the expenses made during a particular financial year should be recorded in that year's financial statement, irrespective of the fact that whether the cash has been paid or not, right? So here in this example, as we know that the cash of amount of 1,000 was not paid, right? But this salary amount belonged to this particular financial year, so it was shown up here, right? So irrespective of the fact that the cash has been paid or not, it will be recorded in the financial statement. Similarly, this amount of 5,000, it did not belong to this financial year, it belonged to the next year, so it was deducted from this year's insurance premium, right? So only those expenses which relate to this relate to a particular financial year will be shown up in their financial statements, right? This was the matching concept. The next and the very important concept is the accrual concept. See, the whole accounting statement and whole system of accounting is based on the accrual basis and not on the cash basis. By accrual, we can also say a due, What is the meaning of accrual? Accrual means due or lying outstanding, right? So the whole system of the accounting is based on accrual basis, and it is not based on the cash, right? And this we have learned from the previous two concepts of the matching concept and the revenue recognition concepts, that the final concept, the final accounts, the financial statements should incorporate the expenses and revenues which are relevant for the current accounting period, whether settled in cash or not. So the revenue recognition concept told us that we should enter all the amount of the revenue which belong to a particular financial year, irrespective of the fact that it has been received in cash or not. And the matching concept told us that all the expenses related to a particular financial year should be recorded up in the financial statement, irrespective of the fact that whether they have been paid in cash or not, right? So when we combine these two concepts, what we come up with is the accrual concept, which says that incorporate expenses and revenue in the accounting period, whether these have been settled in cash or not. That is why we say that the accounting is not based on cash, it is based on accrual basis, right? It does not matter whether the cash has been paid or not. If the expense belong to a particular financial that year, then go ahead with it, right? It does not matter whether the cash has been received in the terms of cash or not, right? A revenue has been received, an income has been received in the terms of cash or not. If that income, if that revenue belongs to a particular accounting period, belongs to a financial year, then incorporate that in the financial statements, right? So accordingly we make the adjustments, the accountant makes the adjustments. On this basis only, all the adjustments related to the outstanding expenses, related to the prepaid expenses, related to the unearned income and the accrual income are made. We learned in the previous concept the adjustment of the outstanding salary, outstanding expenses, right, and a prepaid expenses. These two were learned in the concept of the matching concept, right? And this unearned income and accrued income, you can see we learned it in the revenue recognition concept, right? So when we combine both the revenue recognition concept and the matching concept basics, then what we get is the accrual concept, right? Incorporate all the expenses and all the revenues in your accounting period, irrespective of the fact that the cash has been received or not, or cash payment has been made or not, right? Okay, I hope that this concept is clear. Okay, coming up with next is the last accounting concept, which is objectivity concept, right? By objectivity we means fairness. There is no biasness, right? So if an accountant is preparing the financial statements, he or she should be completely fair in making the financial statements. He or she should have no personal biasness while preparing the financial statements. This is what the objectivity concept says. Objectivity concept says that the accountant should be true enough. The accountant should have no personal biasness in their minds, while preparing the financial statements. And also each and every transaction that the accountant is recording in the financial statement should be supplemented by the verifiable documents. So suppose that an accountant is making entry for the sales which have been made, right? So if the sales has been made in the cash, then he or she will be having with him his cash receipt, right? And even though the sales have not been made on cash, suppose these were made on credit basis, these were not made on the cash basis. If those sales were made on the credit basis, then he or she, the accountant, must be having with him the copy of the invoice, right? So all the entries, whether these were made on the cash basis, whether these were made on the credit basis, all the entries should be supported by the verifiable documents while making the entries in the books of the accounts, right? So the accountants should completely on the true basis, on the fairness basis, on no personal biasness basis, they must be preparing the books of the accounts. And also while preparing the books of the accounts, the accountants should consider that the entry, whatever entry they are making in the books of the accounts, are supported by the verifiable documents, whether in the form of vouchers or cash receipts or invoices, etc. right? So all these were the concepts of the accounting, right? These concepts have been made by the law, which are uniformly adopted by all the accountants while preparing the financial statements, right? Now coming up next are the accounting conventions, right? So people sometimes ask, like students are confused that what is the difference between the accounting concepts and the accounting conventions. See, accounting concepts have been made by law, right? And these are uniformly adopted by all the accountants while preparing the financial statements, right? However, this is not in the case of the accounting conventions. Accounting conventions, are not made by the law. These are uniformly agreed upon maybe by the accountants, and their adoption can vary, right? However, the adoption of the accounting concepts is uniform. It is uniformly adopted by all the accountants, right? But the accounting conventions are not uniformly adopted. There can be certain amount of changes that can be made in the accounting conventions by the accountants, right? So accounting concepts, yes, these are hard and rigid. These are made by the law, which have to be followed uniformly by all the accountants. However, if we talk about the accounting conventions, these are not made by law, and these are not uniformly adopted by the accountants, right? So let's come up to the accounting conventions, right? So the very first one is accounting convention is the convention of full disclosure. As the name itself suggests, that full disclosure, right? So by full disclosure, we mean that there should be the sufficient disclosure of the information which is of material interest to the users of the financial statement. So when the accountants are preparing the financial statements, they should take into consideration the interest of the users, right? So for the decision making of the users, for the material interest of the users, all the information which is required, all the information which is needed by the users should be provided, should be disclosed in the financial statements, right? So the accountants should fully disclose all the information required by the accountants while preparing the financial statement. And why this is so? This is so because there can be a trust building between the users and the organization, right? If the users will be sure that the accountant and the firm is providing the complete disclosure of all the events of the organization, they are not hiding anything from them, then only there will be a trust building between the firm and the users, right? So there should be a complete disclosure of all the events of the organization to the users in the financial statements, so that the users can make their decisions, right? Or there should be a complete disclosure. And if there is any change, even if there is any change of the accounting policies and procedures which have been made by the firm, then that should also be disclosed, right? So there should be no hidden fact, right? There should be a complete transparency while preparing the accounting statements. There should be nothing should be hidden from the users, right? All the information should be disclosed, all the sufficient information should be disclosed, so that a transparency can be made in the accounting statements, right? So if any changes are being made by the policy in the accounting policies, in the accounting procedures, or any other kind of the changes which are being made in the organization, and that are of the use to the users of the accounting information, then that should be disclosed, right? So everything should be disclosed so that the trust can be built up, so that the transparency can be maintained, right? So any change if is going to be made in the near future, organization is planning for any changes, then that should also be communicated to the users, right? So everything need to be communicated by the accountant to the users in the financial statement, in order to build trust and in order to build transparency, right? Full disclosure should be there. Okay, coming up next is the convention of the consistency. Consistency, what we mean consistency, that there, for example, we say that we should be consistent in our practice if we want to excel in something, right? So if the organization is following, it is adopting certain principles, if it is adopting certain methods, then the organization should be consistent in adopting those principles, in adopting those methods, and these should not be changed from time to time, right? So all the organizations should follow the accounting principle and methods on consistent basis from one year to another, right? There should not be changes in the adoption of the accounting principles and method, that for 1 year you are following a particular method of the accounting, and in the next year you are following another method of the accounting, right? So that should not be changed, right? And if that is being done, obviously that should be disclosed, as we said previously, that there should be a full disclosure, right? So first of all, first thing first come, that there should not be changes in these methods of accounting, right? But if it is still being done, then that should be disclosed properly, right? See, if the organization will do this, right, it goes on changing its method of the accounting, then it will be difficult and to compare the accounting statements, right? Now suppose that the organization is following the method of it's following a particular method of depreciation on the fixed assets, right? So we have, say, two methods, right? Depreciation is charged either on the original value method, or it can be on the written down value method, right? There are two methods of charging the depreciation on the fixed assets, right? So say for a particular financial year, organization is adopting this method of the depreciation, right? So if the organization is adopting this method of original value method of the depreciation, then it should be consistent in following this method only, right? If an organization is following this method of charging the depreciation on the fixed asset, then it should be consistent on this method. It should not change it should not change between the methods of charging the depreciation, right? So if an organization, suppose it is following this method of original value method of depreciation, so if in the next year it changes to another method of written down value method, then how you will be comparing the financial statements of these 2 years? In the financial year 2021, it was following the original cost value method, right? In the financial year, if the 2022, if the organization shifted to the written down value method, then how you will be able to compare the financial statements of both the years, because the method used in the preparation of both the financial year was different, right? So it will not be able, the users will not be able to compare these financial statements, right? So in order to make the accounting statements comparable, it is very essential that the organization should be consistent in following its methods, right? Okay. The next convention is the convention of prudence, or we also say it as the convention of conservatism, right? Now what does this convention says? This convention says that an accountant should foresee the future losses and provide for such losses in the books of the accounts at the time of preparing the financial statements. However, he should never anticipate the future profits and not provide them in the books of the accounts. See, what is this? If an accountant foresees in coming future that there is a profit coming up in the near future, he anticipates that, he guesses that there is a future profit coming up, right? So if he anticipates her future profit, he should not enter that in the books of the accounts. However, if he anticipates that, if he foresees that there can be a loss coming up in the future for the organization, then yes, that foreseen amount of the future loss should be incorporated in the books of the accounts. For example, there is a there is a court case, right, going up again against the firm, right? And the accountant foresees that that the organization is going to lose this case, right? So there is a future loss that he anticipates. He is seeing in the future that yes, we are on the weaker hand side and the firm is going to lose this case, and on losing this case, the firm will have to make a compensation of rupees 10 lakh to the customer who has made the case against the organization, right? So the accountant has foreseen this thing, that the organization is going to lose the case, the court case, and the firm will have to pay the amount of compensation to the customer, right? So if he has foreseen this loss, if he has anticipated this loss, then the accountant will be making the adjustment for this foreseen loss in the financial statement, right? However, if he foresees in the future that yes, we are like if we are going to sell particular land or building, and if we are going to reap a profit of rupees 2 lakhs, right? The accountant is foreseeing that there is a good increase in the market value of a particular land and building, and if the organization will sell that land and building, then it is going to reap a good margin of the profit, right? So that anticipated profit, no, that will not be recorded up in the books of the accounts. However, the anticipated loss, the anticipated amount of loss will be recorded by the accounted in the books of the accounts. Okay, this is what the concept of prudence is, that the anticipated profits will find no place in the books of the account. However, the anticipated future losses will be taken into consideration while preparing the final accounts, right? And it is only because of this convention, that in the books of the account, closing stock or the inventory is recorded at the market price or the cost price, whichever is less. We are not talking about the fixed asset. We are talking about land and building or so. We are talking about the closing stock or the inventory which is lying up with the organization, right? So when we enter the amount of the inventory or the closing stock in the books of the account, it is done at the market value or the cost value, whichever is lesser. If the market value would be lesser, then the market value will be recorded in the books of the accounts, right? If the cost price was lesser, then the cost price will be entered in the books of the accounts, right? So we are not taking a brighter side in the books of the accounts, we are taking a lesser side in the books of the accounts, right? So it is only because of this convention that the closing stock or the inventory is recorded at market price or cost price, whichever is less. Similarly, a provision for the doubtful debt is created in the anticipation of the bad debts, right? So if the organization has certain amount of debt, the organization suppose that has certain amount of debtors worth rupees 2 lakh, which it is anticipating that will not turn out in the near future, that the debtors amounting rupees 2 lakh will not be paying the concerned amount back to the firm, right? Then these will be known as the doubtful debtors, right? So for these doubtful debt, a certain amount of provision is made by the firm, a provision that is known as the provision for the doubtful debtors. So because this amount of doubtful debt has been anticipated, this loss has been anticipated by the firm, and a provision for that has been created. So for any anticipated loss, right? So this is an anticipated loss because it is being considered that the debtors will not turn out to be fruitful for the firm. These will be doubtful in the near future, right? And a provision is being created by the firm. So that loss, that anticipated loss will find the place in the books of the accounts because all the anticipated losses are entered in the books of the accounts, right? Similarly, suppose that a lawsuit is pending against the firm, and it is not sure that whether the firm is going to win it or not, right? So provision for that will be created, right? A provision for pending lawsuit against the firm will be created in advance, right? It is being considered, it is not sure whether it will be in the favor or not, right? So and a loss is being anticipated that yes, if the firm loses that particular case, that lawsuit, then for that anticipated loss, a provision is being created. So a provision for pending lawsuit against the firm, obviously it is an anticipated future loss, and because this is an anticipated future loss, it will be recorded in the books of the accounts, right? So it is only because of this particular convention that the provision for the doubtful debts and the provision for the pending lawsuit, which are all the provisions for the anticipated losses, these will be finding the place in the books of the accounts, right? All the anticipated future losses will be taken care of while preparing the final accounts. However, the anticipated gains will not be recorded up, will not be there in the books of the accounts, right? I hope this is clear. Now coming up next is the last one, the last convention, that is the convention of materiality. It is actually a complete a contrast to the convention of the full disclosure, right? The convention of the full disclosure, what does it say? That everything should be disclosed which is of interest to the financial users of the financial statement, right? However, the convention of the materiality is saying that only those things should be recorded up in the books of the accounts which are material, which are important, and insignificant and unimportant things should not be shown in the books of the account, right? So these two conventions actually are in contradiction to each other, the convention of the full disclosure and convention of materiality. The first one said to disclose all the things, right? So that there is trust building can be there, so the transparency can be there. However, the convention of materiality is saying that the unimportant things, right, or certain kind of things which are of mere nature, these can be ignored, right? So this says that only material things should be shown, and the items which have insignificant impact, right, or which are irrelevant to the user, these can be left out, right? Suppose if I say that there is a difference of rupees 500 in cash, right? So in the cash balance was found out by the accountant, right? So that can be important, that can be material, right? However, a difference of rupees 500 in the value of the raw material or in the value of the stock, right, it may not be very material for the users of the accounting statement, right? So only those things should be recorded up, only those things should be entered in the books of the accounts which are of significant nature to the users, right? Anything which is irrelevant for the users or which is insignificant for the users should be left out. This is what the convention of materiality says. That is why I said that the conventions, these are not uniform in nature, right? These both are contradictory to each other, right? However, the accounting concepts that we studied earlier, these were consistent, these were made by the law, and these have to be adopted by the accountants as has been told, right? However, these accounting conventions, right, these are not uniform, these can be molded by the accountants, these have not been made by the law, right? I hope that this video is all clear to you, the accounting concepts and the accounting conventions, right? These will be useful to you while making the entries in the books of the accounts. So I hope that you liked the video. Thank you for watching, and please do like and share my video. Thank you.